At our group for Chapter 7. Chapter 7 was talking about accounts receivable and more appropriately talking about subsidiary ledgers for accounts receivable and how we deal with accounts receivable with credit card companies. As you'll see, I have an Excel window opened over here to help demonstrate some of the calculations that we're going to make. So when you get ready, let's go ahead and get group Chapter 7 started. So we're talking about Mayfair Company, and they allow customers to make purchases on credit. That simply means that we are extending credit directly to customers, and we're going to have a subsidiary ledger for each customer in our accounts receivable. Looks like Mayfair also allows customers to use either of two different types of credit cards, either their Visa cards or Access cards. Visa deducts a 3% service charge against Mayfair for sales on its credit card and credits the bank account of Mayfair immediately. That means when a customer uses a Visa card, we're going to get our money right away minus the 3% charge. Mayfair deposits the Visa card receipts each business day. When customers use Access credit cards, Mayfair accumulates the receipts for several days before submitting them to Access for payment. So customers use Access card, they leave a paper receipt, and Mayfair has to send those receipts into a processor, mails them in, and then that processor sends Mayfair a payment back. Access deducts a 2% service charge and usually pays within 1 week of being billed. And what this means is that every time a customer uses an Access card, that we now have an accounts receivable from Access. It is Access that owes Mayfair the money. Mayfair completes the following transactions in June. All credit sales are $215 net 30, and all sales are recorded at the gross price. So we'll see here there are several transactions in June 4th through June 18th. We're going to walk through each one of these. The problem is asking us to prepare journal entries for each of the transactions and events. Always, always, always look at the lettering in red there. If no entry is required for a transaction or event, select no journal entry required in the first account field. Foreshadowing as it may be, you can expect that there's probably at least going to be one transaction that's going to require that, because I think it's the first time we've seen that in any of our group work for Connect. So here we are, journal entry number 1. It says that we sold $650 of merchandise on credit to Natera Morris. Doesn't say anything about Visa, doesn't say anything about Access. So we have to assume that we are extending credit directly to Natera Morris. So what do we have? Well, I think our debit then should be an accounts receivable for N. Morris. We've got to go find that. There it is, accounts receivable N. Morris. Ms. Morris now owes us $650. And what do we have? Simply enough, we have sales for $650. All done. We move on to our next journal, and it says record the cost of goods sold of $400. We are still talking about this June 4th entry. On June 4th, we sold $650 to Natera Morris, which had a cost of $400. Remember, every sale transaction has two different entries, one for the sale and the other to move inventory into cost of goods sold. So cost of goods sold is going to get our expense for $400, and we're going to take that out of merchandise inventory with a credit of $400. Cost of goods sold transactions are the easy ones. I'm going to record that entry. Sold $6,900 of merchandise to customers who use their Visa cards. Remember, at the top, it says that Visa is going to put the money in our account immediately minus a 3% service charge. And we sold $6,900 worth of merchandise. So I'm just going to go ahead and calculate that here. So merchandise sales was $6,900. The Visa service charge is 3%. So the amount deposited should be the difference. Whoops, I guess actually we should say the total Visa charge which then will give us the amount deposited. So let's calculate that Visa charge first. So I'm going to multiply 6,900 times 0.03. The charge looks like it's 207. So therefore the amount that we should be depositing would be 6,900 minus 207. We'll see the math there. The amount we should be depositing is 6693. Back over here to the journal entry, what do we get? Well, we get cash of 6693. I'm going to skip a line, move on down here because we have sales, and sales is always, never changes. Sales is always going to be the full amount of the 6,900. So now, and the reason I left a blank is because I was wanting to demonstrate that we need to figure out whether we need a debit or a credit. And it's obvious now that we need a debit. That debit is going to be this 207, and it's going to go to credit card expense. And that'll be your first journal entry for a Visa sale. Now we need to ask ourselves, if we made a sale, what other transaction would have to go along with this? And just like I said prior, we have to record the cost of goods sold. If we look at the transaction, we'll see that cost of goods sold was $4,200, and we take that out of merchandise inventory, $4,200. This is always going to work this way, no matter what. There's your cost of goods sold merchandise inventory for that June 5th transaction. We move on to our June 6th transaction. It says we sold $5,850 of merchandise to customers who use their access cards. So I'd say we really have kind of the same thing. I'm just going to take this and copy it down here, and then we'll change a couple things here. Instead of saying the Visa service charge, we'll say the access service charge. So we'll take Visa out, we're going to call it access, and whoops, that didn't work out too well, did it? There's Visa. We'll do it up here. My function keys don't want to work right when I'm recording. There. Our total access charge. And we know that the access charge, if we run up here, it says that access is going to withhold, where is it? A 2% service charge. So we'll change that number there and we'll see what happens. It says we sold $5,850 of merchandise to customers who use their access cards. So 5850 here, if we multiply that by 2%, is 117. And now we take that 5850 minus that 117, and we'll see how much will be deposited eventually, at least, because this is access. And the instructions tell us that access does not give us our money immediately. They give us our money within about a week of submitting those receipts to them. So in this case, we don't have cash as a debit. Access owes us money. So we have an accounts receivable from Access. The amount that Access owes us is this $5,733. We have a credit card expense, that's the 2% there, of 117. And of course we have sales of 5850. Okay. Knowing that I need to keep track of all of my Access sales, I'm going to go ahead and just create a little ledger here. Here's my June 6. Access owes me at this point 5733, so I'm going to roll that over there. I'm going to record my entry. We have to record cost of goods sold. At this point, hopefully you already know it's just a debit to cost of goods sold for the amount and a credit to merchandise inventory for the amount. Now, we sold another $4,350 of merchandise to customers who use their Access cards. Now I can simply just change this to $4,350. It's going to do all the math for me, good old Excel. What do we have? Again, we have an accounts receivable for Access, and it's in the amount of $42.63. We have a credit card expense of $87, and we have sales of $43.50. Can you guess what the next transaction would have to be? Hopefully you guessed correctly, and you'll be recording cost of goods sold at $2,900, taking away from merchandise inventory $2,900. Then we come up on June 10th, and it says that let's do this real quick. What was that last one? The date was June 8th. June 8th. Let's put our other receivable in here. June 8th. We had $42.63. That's how much Access owes us, these two things. Here we are, June 10th. We submitted the Access card receipts accumulated since June 6th to the credit card company for payment. It means that we've sent these two receipts now to Access, and the question is, what entry are you supposed to record? Well, if I think back, I've already recorded the sale. I've already recorded the cost of goods sold. The only thing I haven't recorded is the cash, but I don't have cash yet. And this is that one entry in which we had some foreshadowing. This is going to be a no journal entry required. All we're doing is mailing out some receipts to Access, asking them to pay us. No journal entry required for number 9. We move on to number 10, and it says that we wrote off the account of Abigail McKee against the allowance for doubtful accounts. The $429 balance in McKee's account stemmed from a credit sale in October of last year. And you might sit here and think, I don't know exactly what to do with this. I mean, this is the only information we have about McKee, but really it's the only information that you need. They're telling us that they utilize an allowance for doubtful accounts rather than direct write-off. So when we deal with an allowance for doubtful accounts, we are already recording the bad debt expense based on an estimate. And then when we actually write off a customer's account, we simply take it out of the allowance for doubtful accounts. So here on June 13th, I'm going to debit the allowance account. When we create the account, we credit it. So now when we actually write it off, we're going to debit the account for Ms. McKee's $429. And then we have to take her receivable off the books. There's the accounts receivable for Abigail McKee, and we're going to say that she no longer owes us that $429. All right, we get to June 17th, and it says, how much did you get from Access? Well, then I want to go ahead and total this up. So total from Access, and we'll go ahead and sum this. $9,996. That's what we received. It's cash. We don't have to worry about the service charge. We already did that. $9,996 is how much we received, and Access no longer owes that to us. So accounts receivable Access 9996 is our credit. Just totaling up the two things that Access owes us. And then finally we get to June 18th, and it says that we received Morris's check. This is Natera Morris, right? Morris's check in full payment for the purchase of June 4th. That was the purchase that we did back here on the 1st when we sold $650 worth of merchandise to Natera Morris. So what have we received? Well, we received cash because we received payment. And of course we're going to take the accounts receivable off the books. You notice I'm skipping a line, which obviously means that we've got something else going on there. Whoops, picked the wrong one. Accounts receivable for N. Morris, and she owed us $650. Well, we know that she no longer owes us if we received it. So why did I skip that line? Well, it's currently June 18th, and if we look here at the top, we do all credit sales are 2% if paid within 15 days, otherwise net 30. We sold this on the 4th and are now receiving payment 14 days later. So I am positive that Natera is taking a 2% discount on this sale. If I calculate that 2%, I'm just going to roll over here a little ways. If we have $650 and we multiply that by 0.02, we'll see that it is a $13 discount. We know from a prior chapter that that will now go to sales discounts. Sorry, I Got my caps lock on there. Sales discounts gets $13, and therefore we must have received $637 in cash. Okay, so I'm going to go ahead and clear out our worksheet over here so that we can use it as we move along. That should complete the first part of the assignment. So I'm going to go over to questions 2 through 4, and we're going to deal with some bad debt expense. More particularly, we're going to be dealing with an allowance for doubtful account. Talking about Hawk Company, December 31, 2015, reports the following results. It shows us how much they've had in cash sales and credit sales. Shows us the balance in accounts receivable, and the allowance for doubtful accounts currently has a debit balance. The allowance account, recall, is a contra account. That means that it should normally have a credit balance, and this would mean that we've actually written off more than we estimated we were going to write off. So this account now has a debit balance. And we get down here and it says, prepare the adjusting entry for the company, this is for Hawk, to recognize bad debts under each of the following independent assumptions. Independent means that each one of these is an independent scenario. You're never going to do all three of these things at the same time for a company. It's going to be one or the other, but never all three. They just want us to see how each one of those works. So we want to first estimate bad debt as a percentage of credit sales. So that's the first way. We want to take it as a percentage of credit sales, and it says let's take it at 1.5%. Well, that should mean that I need to take credit sales less a 1.5% discount for the total bad debt. That's what it's asking us to do. So if we take credit sales of $5,682,000 times 0.015 and we do the math, I can already see that we have just a little bit of a formatting issue here. Let me go fix that for you real fast. There we go, 0.015. It was set to only show 2 decimal places in my function. It says that bad debt should be $85,230. So that's what it's looking for. How do we write that off? Simply, we go to bad debt expense, debit $85,230, and our allowance for doubtful accounts, $85,230. That's estimating on a percentage of sales. I'm going to go ahead and record that entry. And now it says, look at the independent assumption where bad debts are estimated to be 1% of total sales. Okay, so we need total sales. Oh, so let's figure that out. If I need total sales, what am I actually looking at here? And you'll see that we have cash sales and credit sales, so we need to do a little bit more math. Cash sales and credit sales, and it looks like cash sales were $1,905 and credit sales are $5,682,000. So total sales is the addition of those two things. Whoops, I got a little bit careless there. Plus the 1,905 plus the 5.682 million gives us 7,587,000. So total sales of 7.587 million, and if we're going to take 1% of total sales, we're going to calculate it just like we did the prior, at 1% discount or service charge, whatever you want to call it. 0.01 means that our total bad debt is going to be a multiplier, 7.587 times the 0.01, and our total bad debt expense should be $75,870. Go ahead down to our journal entry. Again, the debit is going to be bad debt expense for the $75,870, and our allowance for doubtful accounts is going to be $75,870. All right. So now we get down to the final one, and this independent scenario says that an aging analysis estimates that 5% of year-end receivables are uncollectible. And if you recall from class, I mentioned that this is the one that most CPAs would probably like to use because it automatically adjusts the allowance account to be the amount that you want it to be. So to demonstrate that, I'm just going to go ahead and show an allowance account. And currently, the allowance account has a debit balance of, if we look up here, $16,580. Well, the account should normally have a credit balance. So the normal balance in this account would normally be a credit. So in order to show that it has the wrong side balance, I'm going to indicate this debit balance with a negative sign because minuses basically are decreases in the account. And that's what we have. An increase to an allowance account would be a credit or a positive. So it currently has a debit balance. And what this scenario is asking us to do is to show what we believe the ending balance should be. And it says an aging analysis estimates 5% of year-end accounts receivable are uncollectible. Well, here is accounts receivable. It's AR is $1,270,100, and we believe that 5% is uncollectible. So now we have the total uncollectible, which should be our allowance. So we take the 1.270 million times the 5% rate, and we see that we want our allowance account to have a $63,505 balance. Well, you might think that's simple, but what we're saying is that we want this ending balance to be $63,505, and the question becomes, what adjustment do I need to make to the $16,580 debit to make that $63,505 credit? And what has to happen is that if I'm going to create a $63,505 positive from a $16,580 negative, then I need to adjust the account by a positive $80,085. If I were to add these two numbers together, I'll just show it down here, an error check, that if I say plus 16,580 plus 80,085, I get 63,505, and it's because I'm adding a negative to a positive. Probably the more difficult problem we have here. Run on down to the journal entry, and again, what do we have? A debit to bad debt expense for the adjustment of 80,085, and then allowance for doubtful accounts 80,085. We'll record that entry and run on down to the next problem. And they're asking us to show how the accounts receivable and the allowance for doubtful accounts will appear on the December 31 balance sheet given the facts in Part 1A. Well, that would be for this first journal entry where we credited $85,230 to our allowance for doubtful accounts. I'm going to go ahead and zero out our Excel sheet. Actually, I'm only going to zero out a part of it because remember, our allowance account already had the $16,580 balance. I'm going to go ahead and turn this into a formula. So in this scenario, for number one, we did a credit of $85,230 to the account. And if we credit $85,230 to the account, you'll see that the balance changes to $68,650. So under our current assets section, we show accounts receivable at how it was listed, which was for $1,270,100, and we take away our allowance account, and that would be now a negative $68,650. Here it is, we just calculated it, leaving us with a net receivable of $1,201,450. We roll down to the next one. It says show how accounts receivable and the allowance for doubtful accounts appear given the facts in Part 1C. And that was the last one that we did, where we adjusted the account. It would be journal entry number 3. Once again, now the adjustment was $80,085. And this was the one where we had calculated we wanted our ending balance to be $63,505. Go back over to Connect. So with our ending balance now calculated as $63,505 on the balance sheet, accounts receivable, not accounts payable, will be, again, the $1,270,100. And if we take away our allowance for doubtful accounts and say minus $63,505, we have a net receivable of $1,206,595. If you get it all done, save and exit or hit submit, and you are good to go on Group Chapter 7.